What's better than working for your money? Having your money work for you. Here's how dividend investing can make that happen. First off, a quick rundown on dividends. A dividend is a portion of a company's profits paid out to shareholders. They're a company's way of giving back to its investors. Dividends are typically paid in cash, but they can also be paid in stock too. And companies can pay dividends no matter if the market is up or down. And getting paid isn't the only benefit of dividends. Here are 5 key reasons why dividend investing might become your new favorite strategy. Reason number 1, dividends can offer consistent returns. Dividends make up a significant part of the Canadian market's overall performance. In fact, between 1977 and 2023, almost 1/3 of TSX returns came from dividends. That's a big piece of the pie. And what's nice is you don't have to time the market or sell your stocks to earn that money. You can receive payouts at regular intervals just by holding your shares. It's a bit like receiving a paycheck from your investments. Reason number 2, dividends offer more financial flexibility. Some investors think of their dividend income as a side hustle of sorts, something to help supplement their income outside of their regular job. For example, for freelancers or entrepreneurs, dividend income can add an extra layer of financial security in between gigs. And for retirees, dividends can offer a steady income stream to help pay the bills. Ultimately, dividend income is basically extra money in your pocket. Reason number 3, dividends can help stabilize a portfolio. Historically, dividend stocks have tended to be less volatile than growth stocks, meaning they may help cushion your portfolio when markets get rocky. This is because companies that pay consistent dividends are typically more mature, stable, and financially healthy. But of course, there is a trade-off. Remember, companies are giving part of their profits back to investors when they pay a dividend. This means less money is available to reinvest into the business to fund future projects and expansion. So on the one hand, investing in a dividend-paying company might not give you the same explosive returns as some small cap or high growth stocks, but on the other hand, it can add some stability and diversification to your portfolio. Reason number 4, dividends can create more compound growth opportunities. Many investors choose to reinvest their dividends into buying more shares of the company rather than spending them. Why? Well, more shares can produce more dividend income, which can then be used to buy more shares, and those shares can generate even more dividends. This is compound growth in action, a cycle that can lead to larger and larger returns over time. Say you invested $10,000 into the S&P TSX Composite Index on April 30th, 2015, and held your investment for 10 years until May 9th, 2025. If you spent your dividends as you earned them, your portfolio would have grown to just over $16,000. Not bad. But if you reinvested those dividends, your portfolio would be worth roughly $22,000, more than double your initial investment. So you may want to consider a dividend reinvestment plan, or DRIP. It allows you to automate your reinvestment of dividends without paying a commission fee. And reason number 5, dividends can create tax advantages. Here's a hidden gem about dividends. There are special tax rules for dividends earned from Canadian companies. Dividends typically come from a company's after-tax profits, meaning the company has already paid taxes on those funds. So to prevent double taxing of that money, Canadian dividends are included in income at a grossed-up rate, but also qualify for the dividend tax credit. This ultimately means Canadian dividends may be taxed at a lower rate than they would have been had you earned that income as interest. Now, this all might sound a little complicated, so let's run through a quick example of how this might look when filing your taxes at the federal level. First, you would need to gross up the dividend income by the rate specified by the Canada Revenue Agency, and then apply the dividend tax credit. As of May 30th, 2025, the gross up amount is 138% for eligible dividends, and the dividend tax credit is 15.0198%. So say your current income tax rate is 33%, and you've received $400 in eligible dividends this year. Thanks to the gross up rule, you'll need to report it as $552 in taxable income. Now, if we apply a 33% tax rate to that, it comes out to just over $182. Next, we apply the dividend tax credit of 15.0198% to the grossed up amount. That gives us a credit of just under $83, which helps bring down the overall tax bill. So not only can dividends allow you to earn passive income, but the tax advantages mean you might be able to hold on to more of it too, and that's a win-win. Now, as much as dividends have their perks, it's important to remember they carry some risks too. Companies can cut or lower their dividends at any time. Plus, high dividend yields can sometimes be deceiving. This is called a yield trap, and it's an important one. So we're going to get into it in more detail later on in this course. Ultimately, though, dividends can offer a lot of benefits. Just make sure you do your research before jumping in. And this course is a great place to start. In our next lesson, when and how to get paid as a dividend investor, we'll take you through how to figure out the amount you can expect from your stocks, when to expect it, and how to spot those sneaky yield traps.
Have more questions? Check out the links to the right and in the description below.